To file taxes is just days away, and taxpayers are hoping to maximize their deductions.
The former CEO of TurboTax is out with a new book detailing investing strategies that allow taxpayers to minimize or even totally eliminate what they owe to the IRS. And Bill Harris joins us live via Zoom. Good morning, Bill.
Hey, good morning, Lauren and Marcus. How are you?
Doing well.
Great.
Thanks for joining us this morning. So April 15th is almost here, but what strategies can people take, maybe even potentially for next year, to try to prevent how much money they pay back to the government?
Well, that's really the important question. It's not about last year, it's about this year. And you can set yourself up so rather than paying as high as 50% in taxes on your investments, you can pay as low as 0.
How do you do that?
Couple of things. First of all, take your money out of bank accounts and CDs. That's where you pay the highest rate. In fact, in Illinois, you've got a 5% tax rate, and then in addition to the federal tax, it's about 50%. That's what you pay in your bank account. Take that money and put it into treasury bills and municipal bonds, which are exempt from many taxes.
And this is kind of sorry, this might be a simple question, but I don't know the answer. Is it easy? So if you're saying take my money out of my bank account, like, are you talking about the savings bank account? You're talking like my checking account? How much money, like, can I get money out of those bonds quickly, like if I would need that money?
Yes, I'm talking about your savings account, not your checking account.
Yeah.
You need the money in order to go day to day. But if you've got long-term savings, either in a savings account or particularly in a CD, put it in a brokerage and put it into municipal bonds or treasuries. The easiest way to do that is with a ETF, a fund.
I want to ask about the investing apps like Robinhood. What are some of the maybe drawbacks in terms of tax implications for strategies like that?
Well, unfortunately, I think Robinhood is teaching an entire generation that's new to investing exactly the wrong way to invest. Because first of all, it's speculative. You're buying individual stocks, not taking a full portfolio approach. And secondly, if you trade frequently, what you're ending up is with short-term capital gains, not long-term. Short-term capital gains are taxed much higher than long-term capital gains if you keep the stock at least 12 months.
What have you found is the biggest mistake people make when they're filing their taxes?
Well, the biggest mistake is not when you're filing your taxes, when you're planning your taxes. So what you do this year, which you will then reap the benefits next year. The biggest mistake, I think, is when they think about the 401k and the IRA, the tax-deferred accounts, they're putting the wrong type of assets in those accounts. Don't put your stocks there. Put your interest-bearing assets in there. Keep your stocks in your taxable account.
And looking ahead to next year, we're seeing the sunset of some Trump-era tax policies. What can people do to prepare for that?
Well, you're going to see a higher tax rate at the higher levels. You're going to see the elimination of much of the deduction in estate taxes, and so you should handle that next year in 2025, get prepared for that. But as always, the most important thing, far more important than what the tax structure is to make sure that you take advantage of structuring your investments in order to reduce your taxes now so that you'll benefit next year.
You can check out more at evergreenmoney.com. You can also follow Bill on social media. The information is on your screen right there. Thanks, Bill.
Thank you.
Hey, Paul.
Hi there. We're going to watch our temperature.